I'm Aoifinn Devitt, CIO at Moneta, and welcome to this Moneta moment where we are going to discuss recent volatility in markets. This is building on our Moneta moment of April of this year, where we discussed how geopolitical concerns were on every investor's mind. Added to this were concerns about rising inflation, as well as an indication that the Fed was going to continue to raise interest rates. Now, as we sit in the fourth quarter, none of these concerns has receded. And if anything, investors have become increasingly data dependent, just like the Fed, as they look to how react to market conditions. The data that investors are looking at include employment numbers, as well as ongoing inflation numbers. And we're going to look at how that has impacted market volatility. If we look at this first chart, we can see how elevated volatility has been throughout the year. We can also see how accentuated it has been in the last quarter. This was due to the fact that the first half of the year was the worst return for bonds since records began, and we have now just completed our third consecutive quarter of negative returns in equities and bonds. It's also interesting, though, to look at how equity markets behave before, during, and after a recession. And for that, we've looked at some historical data. We can see from this chart that usually equity markets tend to lead negatively running into the year before a recession. During an actual recessionary period, in this case between these two dotted lines, we can see that equity markets are actually broadly positive. By the time we get to 1 year after a recession, equity markets have been positive for some time. This would lead us to be optimistic about equity markets' performance if and when we do enter a recession. We've also spent some time looking at our global equity market performance too. And as the next chart shows, it's actually non-US markets that have done relatively well relative to US markets in the recent period. What has added to their negative performance, however, has been a persistently strong dollar. In this next chart, the two orange bars indicate the developed market and the emerging market index, so that is markets outside the US. We can see that in local currency terms, these markets have been negative, but not as negative as US markets. If, however, we look at those returns in US dollar terms, which are the green bars to the left of each orange chart, we can see that they have been just as negative, if not more negative, because of the effect of a strong dollar. This is not something that we expect to persist in perpetuity, and we would see that this is going to return to the mean in due course, and this is why we remain committed to a global portfolio at Moneta. So what are our takeaways from this Moneta moment? In this environment of ongoing volatility, it is natural that investors would like to see where they can take shelter from the storm. It hasn't been easy with equity and bond markets performing in sync. We've recently issued a piece entitled Shelter from the Storm, where we set out that we advise investors to stay hunkered down, close to base, close to their core asset allocation, ensuring that their core allocation is well diversified in the equity area between value and growth equities. We also don't recommend a lot of shifts at this stage. We do, however, endorse the importance of alternatives as a way to ensure that there is balance and all-weather in a portfolio and that it is resilient from all forces, including inflation. I'm Aoifinn Devitt, and thank you for listening to this Moneta moment.